Okay, so welcome to the 7 stock formula. This is going to be the meat of the class where we go through and we talk about the different stocks, why they're important, and the 3 different ways that you can really adjust your 7 stock strategy. So let's go ahead and get started. Number one, we have to examine the tickers, okay? I mentioned the list. Now let's examine it and put it into practice. Number one, we start with identifying the stock from the list. I'm going to go ahead and use my 7 stocks list. Next, we're going to use the spreadsheet, the calendar, and the checklist, and then we're going to do it to trade or not to trade based on identifying which area of risk and reward you are most interested in. So let me go ahead and present this list. Like I said, you do have to keep in mind that this can change based on earnings events, volatility, but for the most part, it does stay the same. So these are some of the top 7 stocks that I have used to trade since the beginning of my trading career, and these are the ones that have the most premium in their out of the money options, and they also have a relatively decent trend. Now, Tesla, I'm sure you've heard me talk about how I don't really have a ton of luck with Tesla. When I say that, I primarily mean trying to get the directional move, like the squeeze or something like that, but doing something with out of the money premium is a little bit different. ServiceNow is another one that has gotten pretty strong. And I do like this one a whole lot. We also have Facebook. So let's go ahead and dive in, and we're going to go through the process. So you want to follow these steps, okay? If you get to a step and the answer is no, then the trade is going to be a pass. So number one, is the stock a high price stock with an obvious trend, up, down, or sideways? You have to make your directional choice. Then the second piece of that is going to be to use your spreadsheet. You want to check out the bounds. Once you have the bounds, you price it out. How does the risk reward look? For a $5 wide spread, it should be at least 60 cents. The more, the better. For a $2.50 wide spread, it should be 30 cents. If it doesn't work, the idea is rejected. Now, of course, this also, if you're doing something out of the money like that, then it's going to require you to use probably at least 10 contracts. And then if you're doing it closer in the money, you can use a lower amount of contracts. So then you want to use the calendar to make selections and risk control to make sure that your risk is in check. So moving on to the first ticker here, Facebook. It gets a lot of bad press, but at the end of the day, I mean, it's just technicals, fundamentals, and the overall popularity of Facebook is really strong. So yes, it does get hit by bad news, but it does usually rise again right after that. And at that point, that's also a great spot to get in, which is why it is the Phoenix. So if we look at the chart pattern, what do you see? You want to look at it over the course of the last 6 months or so. You see something that's in a relatively strong uptrend. Now, yes, there was a time period like this. Like, for example, in the last year, we've had political events, tariffs, something like that will bring the stock price down. This is also a great opportunity to come in and use the 7 stocks method, because when you're falling like this and then you find these areas of support at key moving averages, those are great opportunities to come in and use this strategy. So let's go ahead and look at our spreadsheet and our options chain. So starting off, let's go to Facebook, and we want to see what the stock price is right now. So there's Facebook, 201.59, and then you want to look at your the options that are expiring next week. So it's going to be 51.66, Okay, on your implied volatility, we have the expiration date in here of August 2nd. Okay, that's right. Okay, now we want to look at what our spreadsheet is telling us. So I'm going to go ahead and take a screenshot of this for our trading journal. And I'm going to use Snagit, and then I'm going to go ahead and save that. All right, so what do we have here? Well, we have a situation where we have a 1 standard deviation, 1.5, and 2 standard deviation. Now, the other thing you can do, like I said before, is you can do the half standard deviation, which is going to give you a better credit, but it's also going to make it a little bit more probable that you might have to close it out. So we can price it out in 3 different ways. Number one, we're going to start with the out of the money. So if you look at your spreadsheet, you're going to see that your out of the money put is going to be at 185.24. So you want to look down into your options chain and look at your premium to see how many contracts there are, and there's even quite a few even further out of the money. So if we start with just 185 and we're going to sell our put credit spread, you're going to see that this does fit within our parameters because it's 38 cents. Now, if you widen it a little bit more, you're going to see you have about 68 cents. So looking at this here, you have a max loss depending on, how many contracts you have. And I should probably just do this one contract so that you can see a little bit better. So this is the risk reward that you are looking at, and it's good to take screenshots of this so that you can then compare it. So that's 1 standard deviation at about, let's see, that was about 185. So if instead you say, okay, well, I don't really like that risk reward, it's not really favorable, that was a $16 move. All right, well, let's cut that in half and make it 8. So instead of doing 185, 180, if instead you want to come down and say, okay, well, instead of $16, let me do it $8. So that would be about 192, 195, 192. And then you sell something like this. So now you have about a 1 to 3 risk reward. So let's just do one contract so you can see it. So this is going to be a little bit more favorable for the risk reward, but it's going to be a little bit tighter in. And so you can see what the break-even stock price is. The break-even stock price is 193. Now, if you want to do the 5-star strategy, you're going to go out one more week. You're going to go out one more week for 17 days, and you're going to sell the at the money puts. And if you look at that, about $10 wide, I'll just put it down to one contract. Then you have your 1-to-1 risk reward on the trade. So, from there you can just kind of compare what you like best, but it's really nice to have these screenshots to go through and to say, okay, well, this one right here is going to be the 5-star method. So we're going to write 5-star method right here. And then the next one is going to be the half standard deviation method. Okay, and then the next piece of this right here is going to be the 1 standard deviation method. So, I mean, it's hard. It's kind of hard for me doing this class as a straight to recording just because I don't have a live trade portion. So I'm trying to kind of add that live trade portion in without having there be a live trading. So, ideally the goal here is just being able to what you really want to be able to do is you want to go through this stuff and you want to look at the different possibilities that you have and just decide what you want to do with your own trading. So, right there, that was Facebook, and that was walking through 3 different trade setups with the same methodology. So let's go ahead and move on to the next one.